Okay, welcome to today's video where I want to talk to you about risk management when it comes to Forex. What does that mean? Well, it means managing how much you risk on any one trade. Okay, so this is a rule that you have to stick to. You absolutely have to. If you're not disciplined and you don't follow this rule in trading, you will lose money. You'll be part of the 95% of people who trade the Forex market and lose a lot of money. So, really simply, this is what you have to do. You never, ever risk more than 1% of your capital. So what do I mean by that? So if you had $10,000 of capital and you wanted to trade the Forex market, you would never risk more than 1% of that on any one trade, which would equate to $100. Okay. So if you remember in the video when we talked about lot sizes, if you did have $10,000, you could leverage that by 10 times to give you $100,000 to trade with, which would mean you would make $10 a pip. So if this is your capital, 10,000, you're leveraging it up to 100,000, you're only going to risk $100. So that, and it's $10 a pip, so that's 10 pips you would risk. So if you follow the rules and you're looking at a certain strategy, you can only risk 10 pips if that's what you're trading with. Okay, similar if you're trading with smaller amounts and smaller lot sizes, then it's just a difference. You might be trading at $1 a pip or 10 cents a pip in a micro lot, but it's the same principle. What does this mean? Well, it means that you're preserving your capital. So even if you lose 10 trades in a row, you've still got 90% of your capital to play with. Okay, and it keeps you in the game. What most people do is they'll risk 10, 20, 30% of their capital on one trade, and they will just wipe out their capital. And that's gambling when they don't know what they're doing, or they think they do, and they think, oh, the next one I'll win, and they go bigger on the next one to try and recover the losses that they made on the previous ones. That is gambling. That is not Forex trading correctly. What I'm going to teach you is how to be right 70% of the time, have that statistical edge. And if you use good money management, you will just grow this capital. You know, I've grown my capital some days by 19% in one day. But most traders, if you take the average top 5% traders, they're making between 5 and 15% growth a year, very conservatively. Some within that 5% are making 100, 200% return on their capital. So you keep to these rules, you never risk more than 1% of your capital. Okay, what does that mean now? I want to talk about risk and reward ratio. So if we're risking 1%, so let's say we have a £10,000 capital, we've leveraged that by 10 times, so we're trading at $10 a pip. Yeah. Okay, now 1% of 10,000 is $100. $100. So, okay, so how many pips is that? Well, it's 10 pips, isn't it? So on this trade I'm about to take, I'm going to risk $100. That is what I will lose if I'm wrong. If I'm totally wrong and I've misread the market, the most I can lose out of this $10,000 is $100. Okay, now what's a risk to reward ratio? You'll hear a lot about this in Forex. What is that? Well, some people say risk 1 for 1. So I'm looking at risking $100, but if I'm right and it goes in my favour by 10 pips, I'll make $100. So what does that mean? If you're right 70% of the time, it means you would have $700 over 10 trades, and you would lose $300 over 10 trades, yeah? You'd win 7, you'd lose 30 on that 70-30 ratio. So how much would you make over the 10 trades? Well, the difference, if you've won 700, you've lost 300. Over those 10 trades, you'd make $400, okay? Which is 4% growth on your capital. Okay, and you could easily do that over a week or a month, depending on how many trades you want to take, and again the time frames that you're looking at. Okay, now what most people do though is they don't do that. They will risk more. They'll risk twice as much as they win, so they end up with massive losses because they don't keep the 1% rule. They think they're right. They've read an ebook or they've seen something on YouTube. Think this can't lose, this strategy, and so when it starts going in the wrong direction, they don't cut the losses. They don't stop at 10 pips. They think, oh, it'll turn in a minute, it'll turn in a minute, and they end up losing 30, 40, 50 pips. But then when they're right, they get nervous thinking it's going to reverse, so they'll get to 5, 6 pips and they'll take the profits early, so they end up having big losses, small profits, and that's what wipes out their accounts, and that's what the brokers want. Brokers have rigged their websites and the tools that they give you, the training that they give you, for you to blow your account, so you'll come with another 10,000 or another 5,000 and you never learn. That's why you have to use money management in trading. You only risk 1% of your capital, and the minimum you do, the risk reward ratio, is 1 for 1. So if you're right 70% of the time, or you're right 60% of the time, or you're right 55% of the time, you'll be in profit. What I suggest to new traders is to do a risk reward ratio of 1 to 1.5. So if you lost this time 60% of your trades, risking $100 at a time, you would lose $600. If you were right 40% of the time, you would make $600. Yeah, $100 times 1.5, 4 times is 600. So you'd break even at that point. Now, once you get good at trading, and you can read the markets, you can use a risk reward ratio of 1 to 2, 1 to 3. Some people even do 1 to 5. Okay, and it's all about managing that trade then, knowing when to cut your loss and be disciplined with that. You don't hold on to it, you cut the loss when it goes against you, and you manage those winnings, you maximize them by moving your stop loss up. So if the price comes back down, at least you've locked in some of your profit. Hope that makes sense. Any comments, any questions, just put them below. If you like this video, give it the thumbs up, subscribe to the channel, and press the bell so you'll get notified of the next video.